Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. On this podcast, we're talking with a whole lot of macro topics with Matt Luzzetti. He's the chief US economist at Deutsche Bank. Matt has been at Deutsche Bank for 12 years. Previously, he was at the US Treasury of Financial Research and the Federal Reserve Bank of Philadelphia. Matt got his bachelor's in Villanova and his PhD at UCLA. So, welcome to the podcast, Matt.
Thanks for having me. It's great to be here.
So one of the reasons I was exceptionally interested in having you on the podcast right now is because there are a lot of yellow lights on most people's Bloombergs about the consumer. The consumer plays such a critical role in the U.S. economy. So how are you all reading that on your desk? Do you think the divergence between the wealthy and the poor will continue to go the way it has? And what will all that impact be?
Yeah, in many ways, it's an interesting question, especially coming off of the year that we've just had. So if you think about the economy in 2024, it was another year of growth that was above expectations. The economy has continued to outperform. And the U.S. consumer was the big driver there. So the real consumer spending was above 3% last year. And in Q4, we saw the consumer spending grow more than 4% annualized, with actually trends that were accelerating throughout the back half of the year. But you're right. There's been, I think, some concerns potentially coming up about the consumer. Now, some of that we're seeing in the macro data. So retail sales in January were particularly weak. Some of that is probably due to one-offs. We had extraordinarily cold weather during January. That tends to affect the macro data that we look at. You also had the wildfires out in California, and you're coming off of strength from prior months. And so some of that weakness, I think, does make some sense. But at the same time, there's, I think, maybe some growing sense around consumers more broadly, one, being sensitive to prices. We've seen an extraordinary run-up in prices over the past several years. And two, interest rates that are elevated, and that putting particular strains at the bottom half of the income distribution in particular. I think you do have an outlook for the consumer that is somewhat bifurcated. You have the upper half of the income distribution with meaningful income gains, has experienced substantial wealth gains, both from equities and homes, and they're increasingly driving consumer spending, versus the bottom half of the income distribution, where higher prices and higher interest rates are kind of creating a strain that continues to be there. Can this continue? What's our outlook for the consumer? At this point in time, as long as the labor market, I think, remains strong, as long as you continue to see meaningful employment gains, wage gains, I would expect that you do see strong consumer spending and resilient consumer spending persist. But there are, I think, questions now about certainly the wealth gains sentiment, which has been weaker over the past several months in particular.
Yeah. So we are recording this on March 12th. So boy, we've had a couple of days in those equity markets. Maybe some of those things are making people think a little bit. Wage gains are exceptionally interesting also because they're hard to see a trend in because they're noisy as all get out. How do you all read where wage gains are right now?
Yeah, so I think as you look across the variety of data that we look at, and every month when we get a jobs report, we get average hourly earnings. That's a measure that people typically focus on. There's some better indicators, we think, as an economist, looking at wage data. There's a quarterly measure of the employment cost index. You get a measure from the Atlanta Fed that kind of tracks people over time, so it's less subject to all these compositional shifts. I think as you look across those variety of indicators, wage growth has slowed materially from where it was 2 or 3 years ago. That was the hottest wage growth that we'd seen in several decades. Yeah. The labor market has come into much better balance. The unemployment rate has moved higher. But wage gains are still higher than they were in 2019. And you see that kind of across the variety of metrics that we look at. And they look to be stabilizing at levels that are a bit higher than they were back at that point in time. I would also maybe just go back to the wealth effects point that you mentioned. I do think this is important. We have models, kind of simple models for the U.S. consumer, and the wealth gains are an important contributor to consumer spending. As I mentioned, the consumer spending grew about 3% last year. We could attribute almost a third of that to wealth gains. So in the absence of the big run-up in wealth we had last year, consumer spending might have been 2% rather than 3%.
Okay, that is substantial. Isn't it also true that I've seen some research that seems to suggest that wealthier people tend to spend on different stuff than less wealthy people do? And I think this is also interesting because I can connect the last podcast we had, where we had an analyst from Bloomberg who covers casinos, hotels, et cetera, talking about some relative softness that they've seen and how some of those organizations are retrenching around controlling their CapEx spending, et cetera. So how do you figure that into your sort of growth from 3 to 2 because they do spend on different things.
Yeah, and it's definitely true. I mean, I think upper income households will tend to spend a larger share on kind of luxury items and services items, whereas when you look at the lower part of the income distribution, just kind of necessarily they're spending more on necessities. Right. That has also been important for the inflation rates that people experience. Right. They vary substantially across the income distribution. As an example, lower income households spend more of their money on shelter, rents, food, energy, all of these things which have been under substantial upward pressure, and all of these which may be under further substantial upward pressure for tariffs and from tariffs. And so it does suggest some potential pressures for the lower end of the income distribution as we look ahead.
Right. And because you mentioned tariffs, I just would also like to reiterate we're recording this on March 13th, and God knows what's going to happen. and, you know, all you have to do is read the paper right now. I would like to dig into a little bit of the job market because it is illusory in the US. And one of the things that has become a big sort of discussion point is break even employment growth. And I noticed doesn't seem to be consensus among economists right now about what that should be. So, how do you read this?
Sure. So I guess first, how I would define that break-even employment growth. I think it tends to be the trend monthly run rate in non-farm payroll gains that would keep the unemployment rate stable. So it's kind of the data point where if you were at steady state or equilibrium, you would stay at that level. It can change substantially over time. It's unobserved, and so as many things in economics that are unobserved, we don't know what it is, and we can only kind of see it and infer it from the impact that it has elsewhere. I think why it's become such an important question is over the past several years, there was this sense in which the steady state employment number, the equilibrium employment number, rose substantially. And that was driven by a big pickup in immigration flows, essentially a big positive labor supply shock for the economy, which lifted that number. It may have been as high as 200,000 jobs per month on average. But as we worked our way through kind of that immigration flows, as those immigration flows have slowed, and as you have an economy which is aging, more people moving towards retirement age, it will tend to slow that number. So our sense over the course of this year is that the steady state number for employment gains is likely to be 100,000 or a little bit below that per month. Now that will seem like a substantial slowing relative to the past several years of what we've seen. But really important question, if you're thinking about the Federal Reserve or the overall economy, is what happens with labor market slack? So what happens to the unemployment rate? And what happens with wage growth? And essentially what this is telling us is that we could have slower employment gains, but still keep the unemployment rate steady.
Right. And we are undeniably going through some kind of structural shift right now, which you would expect to change in that. Right. It's
absolutely. So ongoing, there's multiple things going on. You have in the background something that would have happened even if it wasn't for the pandemic or immigration flows, which is the aging of the population that tends to put downward pressure on the labor force participation rate, would tend to put downward pressure on labor force growth, and therefore your equilibrium job gains. Overlaid on top of that has just been this kind of massive pickup in immigration flows and then a pretty significant slowdown in that. And so that has led to these dynamics in, call it short-term equilibrium employment gains, right, which were very high last year and 2 years ago, but are also probably slowing pretty quickly this year.
Okay. Now let's change gears here a little bit because I would like to talk about the U.S. growth rate. And as a person who used to be an analyst, I hated these questions, but I sort of love them now. Is how do you calculate the U.S. growth rate with all of the disparate policy statements we have right now, with all of the difficulty in predicting what's going to happen with interest rates? So how are you all doing that?
It is admittedly, I think, a very difficult job. So as you mentioned, I've been at DB for 12 years. I've been the chief economist since 2019. So I was in this seat having to go through the pandemic. And that was, a period of just massive amounts of uncertainty, volatility in the data, and also historically large forecast errors, probably not surprisingly. So, relative to that period, this is
easy.
A somewhat easier period to be an economic forecaster. But look, there are very real uncertainties around key economic policies. What's going to happen with trade policy, immigration policy, fiscal policy, regulatory policy, all matters a good amount. The way that we've approached it is, we set a forecast in November, and that was several weeks after the election. And we laid out what we thought was going to happen across all those key policy pillars and through our modeling work and kind of scenario analysis, built that into the forecast. And we could talk about some of those assumptions. But really, since then, we have not changed the forecast materially, in part because, yes, there are some policies that are being announced. but they're changing on a day-to-day basis. And there's a question about how sustained they're going to be, particularly for tariff and trade policy at the moment. So, for example, over the past few weeks, we've gotten kind of on again, off again tariffs on Canada and Mexico, which can be highly impactful. So, what we are doing, certainly to help our clients and investors think through the current environment, is more so doing scenario analysis. For example, if Canada and Mexico, if those tariffs go into effect and are sustained, this would be the impact on our growth forecast, and this would be the impact on our inflation forecast.
Okay. Scenario analysis is one of those things that's easy to say and hard to do because it requires a judgment factor. So, um, how have you done that? And could you maybe put that in terms of what you do with Mexico, for instance? How has that worked with that, which is like a completely different trading relationship? So it would be a different scenario model.
Absolutely. So, the way that we think about it is we kind of trace out the trading relationships between the different economies, and work through what the tariff impact is. So, how high are tariffs going to go? What will that mean for price pressures in the U.S.? How does that impact disposable income growth in the U.S.? How does the dollar react to that? And therefore, how are importers and exporters impacted? How much do intermediate input costs rise, and how does that work its way through? And so there's some mechanical sense in which you can trace these effects out. But as I kind of just outlined, there's a number of different margins, all with big error bands around it. Yeah. And so there's still a lot of uncertainty. I guess what I would emphasize on top of that is there's this kind of amorphous trade policy uncertainty that is also out there. And so, even if firms, if you had in place tariffs, that would have an impact, but firms would know what the policy is and therefore be able to respond to that and act upon it. I think the difficulty that's been, especially over the past month or so, has been very large in historical spikes in trade policy uncertainty, but without kind of knowing what the policies are going to be. And so I think in the near term, the way that the market has been treating that is a significant rise in slowdown risk in the economy, that it might just be that firms and consumers are pulling back for a period of time until they get clarity on those policies. And that's the more difficult one to quantify. There is very good Fed research on that. So go back to 2018, 2019. And when they looked at spikes in trade policy uncertainty during that period, they thought it could have reduced growth by about a percentage point for the US economy. So just the isolating the uncertainty part of it, even away from the mechanical tariff effects, can be quite impactful.
Great. I will put that into the show notes so everyone who's listening can see that. I'll find that link and put it in the show notes. That'd be exceptionally interesting to look at. Well, let's talk about sort of the other half of this policy uncertainty that leads us to the fiscal deficit, how it's evolving, the debt pile, et cetera. So how are y'all viewing this? What work are you doing on it? A couple of years ago, the bond rating agencies sounded the alarm about this. So, but it seems like it's one of those things that doesn't get bad until it's bad. So,
It is. Yeah, I think, the question that I often get is, what is the tipping point from debt to GDP levels where, bond vigilantes come out and really force reform in Washington, D.C.? And the honest answer there is that there is no ex-ante tipping point. As you look, for example, if you look at 10-year yields versus debt to GDP ratios across advanced economies, think of a scatter plot. There's very little relationship between those two things. You have some economies, Japan as an example, extraordinarily high debt to GDP ratios, but also extraordinarily low bond yields. Yeah. Now, there's some special circumstances there. Much of their debt is domestically held. The U.S., similarly, we have very high debt to GDP ratios, but yields have been generally low in the U.S. And so ex ante, it is hard to know. That said, it is an increasing focus of the bond market and markets in general. If you go back to 2023 during those summer months, it was the key topic that everybody was talking about. The Treasury was guiding towards issuing more debt. Yields at the long end of the curve were rising substantially. 10-year yields hit 5%. And there was a question about, how far could this essentially go? But it didn't take much from policymakers to derail that. Essentially, the Treasury issued a little bit less going forward at the long end. The Fed was able to get dovish, and global investors were able, kind of very happy to come in and buy a Treasury debt that at 5% 10-year yield. So I think it's periodically the key driver of markets. Where we are at the moment is that we've been running historically high deficits relative to GDP, given the state of the economy, meaning we've had very low unemployment, but very high budget deficits to an extent that we haven't seen historically. Now, you also have an administration that is looking to bring this down. to bring deficits down, committing to do that through spending. But we think that ultimately they're going to remain deficits are going to remain pretty elevated over the next several years.
Yeah. Spending is classically exceptionally difficult to change for a president.
It is.
So it's that's one of the things that I find exceptionally interesting. But the question of timing is also surprising to me. Like I couldn't figure out why the bond vigilantes didn't come after UK sovereigns until the shortest prime minister in history started talking about trickle down economics. And then all of a sudden they said, okay, that's it.
Yep.
So I find it exceptionally confusing, hard to read. Do you pay any attention to the Fed's report on who the buyers of U.S. debt are? Because it
Yes.
made a big shift in the last couple of weeks.
It has, and it's always an important question. So this is who is essentially funding the U.S. deficit by buying U.S. Treasury debt, and that shifts over time. I did some work last year with two academics, Kristen Forms and Wen-Chin Du, looking at how that evolves around QT episodes. So as the Fed is running down their balance sheet, essentially who steps in to buy U.S. Treasury debt. What you find in the U.S. is it's mainly U.S. private institutions, hedge funds, households in particular, that over the past several years that have stepped in with QT. But what you've seen a little bit more recently are global public sector reserve managers stepping back from buying U.S. Treasury debt. That's being made up both by domestic investors, but also private foreign investors who are also stepping in and buying U.S. Treasury debt.
Right. So foreign hedge funds.
Well, it could be foreign hedge funds, could be foreign pension funds,
Some foreign
but a
pension
variety of other private institutions.
Yeah. I mean, this is exceptionally interesting. So great. We'll also link to that paper because that is the thing that I think is exceptionally interesting. As you, one of the other things I'm just curious about, it seems like there's been sort of a pause in lots of spending. It seems like it's possible that consumers have paused. Corporations have probably paused also. Have you done any scenario models about how long they can pause for? I mean, like, corporations can only pause for a little while, but before they have to kick up the CapEx machine again, right?
Yeah, I think that's right. I think the difficulty in the current environment is entering this period. If you looked at most of your leading indicators for growth, they were very supportive. So credit conditions have eased pretty meaningfully in recent quarters. CEO and CFO confidence was at the highest level since the Fed started raising rates in early 2022. CapEx expectations from firms across the regional Fed surveys was at the highest level since 2022. Most of the survey indicators were very positive. Now, you've had an abrupt shift in some of those sentiment indicators. And I think it's a response to certainly some of the policies that are coming out of the administration, particularly on the trade side, which have created uncertainty. Now, there's maybe two ways to think about that. One, the administration could change how they're thinking about things and resolve that uncertainty, which could allow us to go back to a world of CapEx expectations being quite high, or the uncertainty is going to continue for a period of time. I think by April 2nd, which is this date where the administration is going to release a number of studies that they're looking at related to trade, hopefully that resolves a decent amount of uncertainty for firms and consumers. And that allows some of the more positive sentiment to evolve, come through, and help spending decisions.
Right, because essentially that makes it harder to walk the policy back.
Because at that point in time, the way that I would look at trade policy at the moment, there's been kind of two rails. The first rail is most of what we've had announced so far. That was done under emergency declarations using this thing called IEEPA, but essentially looking at the border and fentanyl and using that to motivate trade actions. There's a separate rail, which was set out early from an executive order, which tasks the different government agencies with coming forward with trade studies on April 2nd. And that'll be the more process-driven side of trade policy, similar to what we saw last time, using these different measures, Section 301 and Section 232, to think about trade policies around reciprocal tariffs, so equalizing our tariff rates to other economies, potentially more action on China, higher tariffs on Europe. So getting there, I think, will be an important part for businesses, consumers, markets, because hopefully it'll provide clarity on the longer-term plans for trade.
Great. So we'll perhaps leave it there, close our eyes, hope it's April 2nd pretty soon. And thank you, Matt, for being here and being on the podcast.
Absolutely. Thanks so much for having me.
And thanks to you all for listening. As I said, Matt dropped a couple of exceptionally interesting papers there. I'll put those in the show notes so you can see them. And until next time, this has been Compound Insights, and I'll always be your host, Rob Rowan.